Good morning, everyone. My name is Ron Linneman. I wanted to start off with a couple housekeeping items. Number one, there's a chat feature in the box over below. If you click on chat and you type in your questions, we're going to be compiling all of your questions and answering them with a separate Q&A document following the webinar. We want to be respectful of your time, but we also want to compile all the questions that participants have so that everyone sees what questions they have and the answers to those questions. So if you could use that chat feature to ask your questions, and then following the webinar, we'll put together a Q&A and send that out. The slides will also be available on our website, but we'll also send out an email with that information as well. If you are wanting to email or call us with your questions, feel free. Here's our team of our benefits consultants and the account executives. So feel free to email us your questions or give us a call. This slide will be up at the end of the presentation as well, in case you missed it. My name is Ron Linneman. I'm a benefits consultant for WA Group. WA Group is a local 100% employee-owned risk management firm. We work with employers to identify their business and people-related risks and create a strategy to help not only identify those risks, but help employers attain those goals. Today, we're talking about healthcare purchasing risk. And one of the ways that we help employers identify their risks is through our VAST process. It starts with the vision, which is working with employers to figure out exactly what goal they're looking to accomplish, create to identify those goals, create a 3 to 5 year strategy to accomplish those goals. And we can't do it with just our team. We need your team and our team to work together to get to the common destination. It's important for those who are on this call to realize that there is a path of going from where you are today to where you want to be. And some of us on this call might be in one area and some of us might be in another area. But we felt it was important to identify and for employers to realize that regardless of where you are, there is a strategy to get to that destination. But today it's really focused on the insurance financing part of it. But to realize this is not a one-year solution, to know that it does take 3 to 5 years to get to that common goal. And we do it by an education, but we also then lay in different cost containment strategies, which are shown up on the screen to help get to that common goal. So with that, I'll turn it over to Jeannie Lefevre, and she can begin the webinar to discuss the self-funding.
Jeannie, I think you're on mute.
I can't hear anything.
Working on it here.
1 second.
Oh, no, we're unmuted.
Can you hear us now?
Yes.
Yes.
All right, so sorry about that. So we'll get right at this. So today's talk is about self-funded insurance for your health plan and how it can help protect cash flow, especially at this time when it's even more important, I think, for businesses to maintain their cash flow. So who you'll hear from today, myself, Jeannie LaFavor, and then we'll hear from Nick Johnson, who will get into some of the protections you would have through stop-loss insurance and how that works. And then Eric Lamote will go through some case examples of employers who have been self-funded. So Health Easy, who are we? We may not be a household name, but we've been around since 1982. We're an independent third-party administrator, and we are located in Bloomington, Minnesota. And so all we do is administer partially self-funded health plans for employers throughout the U.S. We are not an insurance company, and we don't sell any fully insured products. We're known for our level of customization, innovation, and a very high level of personalized service for our employers. So just briefly, it's hard to imagine, but the Affordable Care Act passed in March of 2010, and with that act, a lot of employers started to look at this model, especially smaller to mid-sized employers. So today, the vast majority of workers are in some form of a self-funded plan, even if that's just an HRA, which many people have adopted to buy down a high deductible on a fully insured policy. We know that employers have been frustrated with double-digit increases. Perhaps you've had to shift costs to employees, but prior to the pandemic, we had very low unemployment rates, so benefits is very important when it comes to hiring and retaining your talent. And one strategy of changing carriers to avoid renewal increases is disruptive, and it's a short-term fix. So a lot of what we're talking about today, as Ron mentioned, is looking at your health plan on a 3 to 5 year horizon, and especially now. So what's happened this year is, as we've all read and heard, there's been, postponement of elective procedures beginning in, I think, around March 10th throughout the U.S. Some of that is coming back. We know in Minnesota they can start doing some procedures next week. But we also have seen a drastic reduction in just your normal claims, your office visits, labs, et cetera. And we've also seen a huge increase in the use of telemedicine, which is something that's been talked about, but not really utilized to the extent it could be. And a lot of clinics are now treating their patients this way too. So we think this will become more of the norm following this, where it's lower cost, convenient, and thus much greatly reduced claims in this model. And so what we've seen is a reduction on average of 35% in the claims for the months of March and April. Now, the same is true with fully insured plans. So the carriers are also not paying out all these claims, but you're still paying your premiums, of course, to those carriers. And this little depiction is really one of the issues that we all face. I think today, are your interests really aligned with the major insurance companies? Again, following ACA, if you watch the stock price of many of the major carriers, their stock continued to increase significantly, while they still complained in some cases about having to take on the uninsured risk and perhaps losing money, but we know that's not the case. They will continue to make profits right now as well. And at this time, we don't know what increases will be for next year, but there have been some trial balloons floated to Wall Street that there might be double-digit increases because of COVID. So there's a lot of talk too in the financial and business journals today about cash. So a lot of businesses, perhaps many of you, have been looking at, can you apply for loans, get advances on lines of credit? What can you do to maintain more cash? I think one avenue that perhaps isn't looked at is your health plan. And so a lot of times it's viewed as a fixed expense that will just automatically go up by a certain amount every year. HR wants and needs to offer benefits to attract the workers you need. I think mostly it can be a reactive process and not purchased like other major business expenses. So if your health plan might be your number 2 expense, it's a way to look at this and say, I should treat this like any other major business. So with the current pandemic, and again, any economic hard times following, if you look at your health plan and maybe can look at this model, you can start to impact your own cash flow. So it might be a bit counterintuitive, but we hope, we'll give you some food for thought. This is a model that can reduce expense and preserve cash. So with this model, you're actually in your own pool. So rather than being pooled with an insurance company, you're kind of swimming in your own pool, but there is plenty of protection for your group and for your plan, and we'll be getting into that in a second here. One of the main advantages of self-funding
Can we mute others not speaking?
Yeah. Can you hand me the? Yeah. But, mute all, just unmute ourselves.
Yeah. Okay, is that better?
Unmuted.
Can you hear us? All right, thank you. At this point, I'm going to turn it over to Nick Johnson, who's going to get into some of the benefits of cash flow, as well as how the stop-loss insurance will work.
Great, thank you, Jeannie. So now we're going to look at a real example of a 12-month cash flow savings. And this is for an employer that we just worked on for May. And it's from moving from fully insured to a self-funded model with Health Easy. So if you see here on the top on this fully insured line, this is what their renewal was going to be for 2020 in May. They were going to pay $1.15 million fully insured. So no matter how many claims they had, that's what they're going to pay. With Health Easy, we were quoting a little bit under that, about $1 million for max liability, with the option to save close to $250,000 to $300,000 if the claims ran well. So if you see over here on the right, this is their cumulative savings month to month. So if you see right here in the first 2 months of moving from self-funded to fully insured, we expected this group to save about $150,000 in a positive cash flow state. And that came from the lag in claims, because once you move from fully insured to self-funded, you have a lag in the claims till they get paid. And then also during this COVID environment, we were able to get this stop-loss carrier to offer 60 days deferment on their stop-loss premiums. So that just gave them a little bit more flexibility with their cash during these May, June, July, where these tough months. So really, when you look at this in the first 12 months of moving over, we projected a total of $307,000 of savings year one versus fully insured. So this is just really a long-term strategy. I know we're just showing 1 year here, but once you're in it long-term, you can see the trends and you can have visibility into your data to make plan changes and changes to the plan. So now let's get into the stop loss insurance. So there's two types of stop loss in a self-funded model. There's specific and aggregate stop loss. And I'd just like to point out that with the HealthEZ model and the self-funded, there is a max liability. So you're not, if you've heard that, I don't have enough cash to cover a giant claim, or I'm on the hook for millions of dollars, we have specific and aggregate coverage, so you're covered on both ends. So the specific side, that is going to cover each individual. So that's going to be your large claim insurance, and it's a dollar threshold or a specific deductible, and that employer would fund all of the money up to that deductible, and then anything over that would get reimbursed by the carrier. And that's, the risk is covered up to unlimited from the carrier. So that's on the individual side. And then if you look at the group side to cover all of the claims on the group, that's the aggregate stop loss. So that's a smaller premium per employee per month premium, and the carrier will set a max liability for the claims fund, and anything over that max claim liability then gets reimbursed under the aggregate stop loss. And with HealthEZ, all of our stop loss carriers that we work with are A-rated, and they all offer various contract terms. And one of the key advantages of being self-funded with an independent TPA is the ability to shop multiple stop loss carriers at renewal. So instead of just getting one renewal every year fully insured, we can go out to 10, 15 carriers and ensure that you're getting the best numbers come renewal time. So I'll just walk through a quick example here of a specific stop loss example. So John, Tom, and Sally all have had some claims. John and Sally are both under the specific deductible, so the employer is going to pay all of their claims out of the claims bucket. But Tom had a claim that breached the specific deductible, so the employer will pay up to that amount, and then anything over that gets reimbursed by the carrier up to unlimited. And then we'll look at an aggregate stop loss. So when you're establishing your max claim liability, what the carrier says your max claims are going to be, they first look at expected claims and then put a little cushion or corridor on top of that. So that will establish your max claim liability, and we call that an aggregate attachment point. So anything over your max attachment point will be reimbursed under the aggregate stop loss. And we do offer aggregate accommodation and advance as well. So if you go over during the middle of the year, we can file to get that reimbursed as the year goes along. And here's an example of how a $127,000 claim would be handled if the group's specific deductible was $25,000. So the employer would pay $25,000 up to that amount, and then the stop loss insurance would cover the additional $102,000 to get that claim paid. And so the amount that is funded but not reimbursed, so $25,000, will apply towards the annual aggregate deductible. And that's just basically applies towards the group's max claim liability. And why hassle with self-funding? So we like to look at self-funding in a 3 to 5 year horizon. We know claims are going to fluctuate year to year, but 3 out of 5 years, you're going to win versus fully insured. So now I'll pass it over to Eric, who's going to go over some real HealthEZ case examples.
Thank you, Nick, for that overview on stop loss insurance. Now I'm going to dive into a couple examples of actual cases with HealthEZ and illustrate how effective the self-funded model can be at allowing employers to retain 100% of the insurance plan profits after paying a small portion of the plan in stop loss premiums, which over 3 to 5 years results in lower expenses. Additionally, the employer has the flexibility to hold on to their cash until claims are due. Under a fully insured model, employers pay premiums. Subsequently, employees incur claims, and then at some point later, the provider sends in a bill and the carrier pays the provider. Under a self-funded model, the employer is able to hold on to that cash until the provider actually needs to be paid. The examples we are showing were picked because there's certain details about the examples that would make people question if it's a perfect fit for self-funding. We'll also address the topic of lasers and how they can effectively be used to help lower the overall plan spend. With that, I'm going to jump out of our PowerPoint and jump into a case example. This first example we're going through is a Minnesota-based white-collar group with about 100 employees on the plan. They were self-funded for quite a few years, and we're starting in the example with their 2018-2019 plan year. The reason we started with this year is because it was not the best year from a claims experience for the group. If you look at the far right side of the page, the year-end loss ratio was 117% on their aggregate coverage, which means that they were 17% over their max liability and claims, or about 40 to 45% above expected claims. The group had a max claim threshold of $833,000, and they had $976,000 of claims that applied towards that $833,000. So in this example, the stop loss insurance would have kicked in for the group and covered everything over the $833,000 threshold. So that helps smooth out bad years such as this. And they had $280,000 of claims over their individual stop loss. So with a claims year like this, typically you'd be anticipating a higher increase at the renewal. So what the group's first year, or what the group's renewal looked like, if you look at the first column on this example, in the middle of the page, their total fixed costs were $307,000. That's the hard cost that the employer pays 1/12 of each month. It goes to pay administrative fees and premiums to the stop loss carrier to cover individual or group large claims. And then they had a claim exposure of $784,000 in possible claims if they incurred that many claims. So if you add those two figures together, they had a max liability of $1.1 million if you round up. Because they were 17% over their max liability and claims in the previous year, their increase on their stop loss increased from an overall max liability of $1.1 million to $1.4 million, $1.46 million, which was a 34% increase. But what we would zero in on is their fixed cost increase only increased $6,000. Their hard dollar increase went from $307,000 to $313,000. So if the group had a good claims year the following year, they would not pay a 34% increase. They might pay a decrease from the previous year. Because of the increase they were looking at, they also wanted to check the market for fully insured pricing as a comparison. They had one quote from a fully insured carrier that was at 16% above current, which was $1.27 million. So if they went fully insured, it was about $200,000 less in exposure, worst case, versus had they stayed self-funded. They had other fully insured quotes that were similar to what their max liability was, staying in the partially self-funded model. The graph up on the screen shows their historical experience. So what the graph represents is if you take what their stop loss fixed costs were on renewal and you add in their historical claims, what their actual spend would look like. So the green bars for the years 2015, 16, 17, 18 are their actual claims for those years, combined with their current fixed costs self-funded. And then the blue bars next to the green are if you take out their large claimants that are no longer on the plan. And then the lowest horizontal line on the graph is what the fully insured premiums are for the 2019 year. So this just shows the employer how we can really dive into their actual experience and evaluate the model. And if their claims go back to where they were running in previous years, they were looking to save quite a bit of money, even though they had more risk on a self-funded plan. And then the higher horizontal lines were where the other fully insured quotes were coming in. The other area that we focused on in the process of evaluating does it make sense to stay in this model versus going back fully insured was actually looking at all of their claimants over $15,000 in claims to look at what their cost might look like the following year. So what this shows is that they had 14 individuals who were over 15,000 in claims. And if you look in the middle of the page on the ongoing column, only 3 of the individuals were ongoing. Some of the people were not ongoing because they were terming off the plan. Other individuals had acute events that were not ongoing events. And additionally, there were some high dollar drug individuals that we were able to address to mitigate those costs for the group. So out of their claims, 673,000 of the group's claims were on these individuals. Much of those costs were not ongoing into the next year, which gave the group a lot of optimism that they were going to run under that expected cost number. The last page in this example is their actual run rate in the current year. This is an 8/1 effective group, so it has about 9 months of data. On the left side of the page here, you see the total of $925,000. That is how much the group would have spent at the 16% increase on the fully insured plan if they went fully insured. And in the middle of the page is what they've actually spent year to date between administration, premiums, claims. The group has spent $597,000. So they are $327,000 positive from a cash standpoint had they taken the 16% increase fully insured. So this is an example of how it's a long-term approach. Had they jumped ship after a bad year, they would not benefit from profiting from the good year. The last example we're going to run through is a little bit smaller employer. Let me just make this full screen. This is a 50 life medical group out in Colorado. This group was an employer who was already in a level funded plan. So on the spectrum that Ron went over at the beginning of the presentation, this group wasn't all the way into a partially self-funded approach, but they were on a level funded plan with Anthem. They had a $40,000 stop loss threshold. Let me try and zoom in a little bit here. They were paying $100,000 a year in fixed costs with a max exposure of $269,000, which was increasing to $318,000 had they stayed with Anthem. But their claims exposure was $200,000 of claims, and their claim reporting was showing they had about $80,000 a year of claims. Based on the plan they were on, the carrier was keeping 50% of any claim surplus they had, versus in a full partially self-funded model, employers can keep 100% of any claim surplus. So with how well their claims had ran historically, that was appealing to them. So even though the fixed costs were a little bit higher with the Health Easy plan, they wanted to be able to keep all of their claim surplus. So this group ended up moving to Health Easy based on this quote. And the page up now shows their year 1 claims experience after moving to Health Easy. So if you look towards the right side of the page in the aggregate claims column, the group had $140,000 of aggregate claims. So these are the claims that the employer was responsible for. So their loss ratio was 83%, so they finished right around expected. 50,000 of that 140,000 of claims was from one individual. And that one individual went over the stop loss deductible by close to $1 million. The stop loss carrier paid out $960,000 of claims for that individual. And the situation with that individual was it was a complicated stroke situation where the person needed to stay in the hospital for several months and generated quite a high amount of hospital bills. The reason we use this example is because the group was only paying $80,000 of stop loss premiums and the carrier paid out $1 million of claims, which would cause a lot of people to question, you know, am I going to even be able to get a renewal? What is it going to look like? Is this going to be sustainable? You know, are we too small to be self-funded based on a year such as this? So after that year, this is what the group's renewal looked like. Their incumbent stop loss carrier was Gerber Life in the first column here. So based on their enrollment at the time we quoted, their fixed costs were at about $160,000. And the initial renewal from Gerber was taking their premiums from $93,000 up to about $150,000. But we had a couple other stop loss carriers we had quotes from that were in the $130,000 range on premiums. Everything we do is an unbundled approach, which means that in a bad year like this, we shop with other stop loss carriers, or in a good year. But if there's a carrier who didn't pay out $1 million of claims, they may be willing to come in more competitively than the carrier who did pay out the claims. So you can stay in the model and you can change stop loss carriers to have competitive risk pricing. So Gerber ended up coming down on their premiums to be in line with the other two carriers at about $136,000 of premiums. The group decided to stay with Gerber, taking into account the amount of claims that Gerber had paid out the previous year. This group is a 1/1 calendar year group, so they just renewed in January of 2020. So through 4 months of this year, we're only about a third of the way through the year, but they've had $4,000 of claims that have been incurred and paid in the current year, which is at 6% of their aggregate. And that large claimant from the previous year has not had hardly any claims at all this year. So from a cash standpoint, this employer has only spent $4,000 of actual claim dollars in the current year. So this is a good example showing that one bad claimant, you know, isn't going to blow up a self-funded plan. The model still does work for groups in that situation. With that being said, we're going to shift gears and go look at how the current COVID pandemic environment is affecting self-funded plans a little bit further. Currently, there's a lot of different actuaries or models out there people are putting out to estimate what the claims impact is going to be from the change in utilization from COVID-19. This is just one of those models that is out there. At the top of the page, the highlighted numbers, 10%, 20%, up to 60%, are estimates of different infection rates within a population. 60% would be really high and unlikely. Somewhere between 10 and 30% would be more realistic. And this model is based on a population of 2,000 employees. Then right underneath that, they're taking into account how many people in the population are over 60 years old at a greater risk or have 2 or more chronic conditions, which those populations would have a greater likelihood of being hospitalized. Then in the middle of the page, the model is estimating the number of hospitalization days and the number of ICU days, and then assigning average cost to those. So when you look towards the bottom of the model, it's estimating that if the infection rate on this group was 10%, they would have $572,000 of COVID-related claims. At a 20% infection rate, that would be up to $1.2 million. But then the other thing that the model takes into account is the drop in utilization of normal claims. A lot of elective procedures are not happening, almost none at this point, but then they'll slowly start ramping back up. So the impact overall, when you net out the drop in elective procedures, is the overall claims volume would drop anywhere from 4 to 5% of a decrease even after paying the COVID-related claims, there would still be a 4 to 5% reduction in total claims. And then at a 60% infection rate, there would be about a break even in claims. So employers who have been self-funded or partially self-funded this year are seeing lower plan costs in general because of a drop in claims volume. The graph on the screen ties back to the example that Nick went through earlier in the presentation. The lower graph on here, the lower line is showing the cash difference for the employer between being partially self-funded versus the fully insured premiums they would be spending on a monthly basis. The bottom line is in a normal environment. So typically we would expect an employer to build up about $100,000 of cash based on this plan was about $1 million overall total cost plan. $100,000 in cash in the first couple of months due to low claims volume, claims starting out low at the beginning and then ramping up. So then once the claims start coming in, an employer would have that money sitting there to cover claims as they start coming in. But because of the stop loss premium deferral, as Nick mentioned on this group, they were expecting to have $150,000 of extra cash after 2 months. And then the line just sort of shows how that projects over the rest of the year. So normally at the end of the year, this group was projected to have about $275,000 better in cash versus fully insured. But because of the drop in claims under the COVID environment, the expected savings was $307,000. On a group by group basis, the results may vary, but sort of the general sentiments from the different estimates out there are that 25 to 35% of postponed elective procedures will not happen. There are several reasons for this. Patients have tried other treatments in the interim and it's managed their conditions to where they decided to put off surgery. Some patients will be afraid to go back into hospitals or surgery centers due to concerns about getting infected. Further waves of the pandemic, a second wave has been talked about coming this fall, could cause lower claims again in the fall. And then normal claims may just not come back in general. There may be more telehealth or other alternative cares. And another reason is that some of the providers just don't have the capacity to catch up with some of these procedures. So some people just will have to put off care because the providers won't have the capacity. Here's a quick chart on the screen showing Health Easy's claims volume from 2019 compared to 2020. Up through the middle of March, our claims volume was higher than it was in 2019. But starting in mid-March, we saw a significant decrease in claims coming into our office because people sheltering at home, staying at home. So we've seen about a 30% drop in claims affected the amount of dollars employers are spending on claims, obviously in a positive way.
All right, thank you, Eric. So in summary, cash preservation, of course, is important for just about everyone. A partially self-funded plan will preserve cash and keep profits on your books. Of course, there will be, 1 to 1.5 years out of 5 that might be worse, but you will probably win most years in the model. And we feel that COVID-19 has only increased the benefits. It's really pointed out the advantages of, when you don't have claims for various reasons, that money stays on your books instead of with the insurance company. So as an employer, you can always look at this model off renewal. Many groups renew in January, of course. But it doesn't hurt to look at it. So, talk to WA Group. If you do want to look at this illustratively, it's always nice I think, to do something when you're not looking at making a decision. So with that, we will turn it back over to Ron. We thank you very much for hosting this and inviting Health Easy to participate.
Great. Thank you to the Health Easy team. As brought up, if you have any questions, please type your questions into the chat box. We'll put together a Q&A and follow up with a document later. The slides and the webinar will be available on our website as well as sent out. And if you have any questions and you want to bring it to the team, or if you want as an employer to evaluate this for your own organization, with health premiums being 4th or 5th on your P&L, it's certainly something that all employers should evaluate for their organization to see if it's a good fit. So please contact one of our consultants to evaluate this for your organization. With that, we'll conclude. Thank you again to the Health Easy team and all participants for taking the time to review and watch our webinar. And we look forward to connecting with you soon.